14.7% inflation. Can this really be? Hello, Diamond NestEgg members, super savers, and course fans. I hope you're healthy and well. So, in last weekend's update, we pointed out that the 2-decade high yields that we're currently seeing for long-term treasuries, such as here for the 30-year, which closed out the week at 5.25%, are not an indicator of inflation heating up, but rather may present a golden moment for savers and investors who are close to or already in retirement and want to lock in a guaranteed income for life with either annuities, treasuries, or other similarly safe bonds. Now, our analysis in that video was based on what the market currently predicts in terms of the expected real yields after inflation for the next 5, 10, and 30 years when you compare normal or nominal treasuries versus TIPS, their inflation-protected siblings. Please check out the link below this video if you want a deeper dive into the numbers. This long-term market prediction is not a guarantee, of course, and it also doesn't mean that there won't be any short-term spikes in the inflation rate. We will only know the accuracy of the market's current inflation expectations when the bond maturities in question actually mature. Nonetheless, we were fairly curious to see whether the inflation report that the Bureau of Labor Statistics published just a few days ago would confirm our assumptions and data-backed analysis, or whether it would lean more towards the media's ongoing narrative of elevated inflation causing market turmoil, especially given the ongoing conflict with Iran. So, with that in mind, here are the 3 topics that we'll be covering today. 1. How high was inflation in July? And might it convince the Fed to raise rates at their next meeting in September? 2. Where did Treasury yields close out the week? In this section, we're going to focus a bit more on some options for those of you in our community who want to lock in the current rates for the medium and long term. And given the overwhelming amount of emails that we've been receiving on the topic, we'll also provide you with a quick update on what the guaranteed lifetime income numbers might look like for fixed indexed annuities, or FIAs, with an income rider, for those of you who can wait a few years to take your income, but still want to squeeze as much juice as possible out of today's rates before they may potentially come down. And 3. For those of you who still want safety but are less focused on guaranteed lifetime income, we'll cover how much more can you earn with multi-year guaranteed annuities, or MYGAs, from top-rated insurance companies. Annuities generally track interest rates, which means that annuity rates are also at very good levels right now. The highest rate we have in this section of today's discussion is 5.65% on a $100,000 7-year MYGA from an A-plus insurance carrier, but some 3 to 7-year MYGAs remain above 5% as well, even with some of the highest rated insurance companies. Let's dive in now, folks. How high was inflation in July? And might it convince the Fed to raise rates at their next meeting in September? Prices for all items in the CPI, the Consumer Price Index, were 0.1% higher than a month ago and 3.4% higher than a year ago, according to the latest report from the Bureau of Labor Statistics that was released this past Wednesday, August 12, 2026. These numbers were pretty much what the market had expected, so neither bond nor equity markets showed much of a reaction. In fact, the S&P 500 climbed to a new all-time high of 7,799 the very next day, while bond yields only moved by a few single-digit basis points overall for the week. More on this shortly. If we look more closely, we can see that the all-item headline inflation rate of 3.4% has come down noticeably since its first oil price-induced spike of 4.2% in May. The same is true for core inflation, which excludes the more volatile food and energy prices. Core inflation stands now at 2.5%, back to the lowest level that we've seen this year so far. There are 2 ways to look at these numbers. On the one hand, a 3.4% headline inflation rate is not too bad, especially if we consider that core inflation was only 2.5%. Plus, both headline and core inflation have been coming down over the past few months, while labor productivity has gone up, resulting in unit labor cost growth that is lower than in early 2022, which should structurally help to keep prices stable. On the other hand, from a glass is half empty perspective, 3.4% is still 1.4 percentage points more than the Fed's often confirmed target rate of 2%. Plus, energy prices were up 14.7% year on year. And if oil prices stay at these levels, or go even higher as the conflict with Iran continues, they could ripple through the entire economy and push all prices up again, at least temporarily. And never mind the fact that our ever-growing federal debt does raise some concerns about price stability as well. So, what will the Fed do when it meets next time on September 16th? The answer is, no one knows, of course. Even the market seems to be as split as the data on what to expect. On the one hand, the break-even inflation rate on the 30-year tips, essentially the market's prediction of what the average inflation will be for the next 30 years, has come down again and now stands at only 2.2%, lower than any multi-year average since 2019, as you can see here. On the flip side, the CME Fed Watch tool still sees a 33.1% chance of the Fed increasing rates by 25 basis points to 3.75 to 4% from the current 3.5 to 3.75%. Now, on balance, we personally think and hope that the 14.7% spike in energy inflation will prove temporary and put more weight on the low break-even inflation rate of 2.2%, the market's forecast for average inflation over the next 30 years. As I've mentioned in our previous videos, we think that there are some deep structural forces at work here, and that the productivity gains from the fourth industrial revolution that we're currently going through should keep prices stable in the long run. Some potential spikes and troughs along the way notwithstanding. But as we often say, everyone's financial journey is different, and your world and economic views may vary. Plus, we've all been witness to how fickle markets can be and how quickly sentiment can reverse course, which is a great segue into the next part of today's discussion, so that you can decide for yourself if this might be a good moment for you to lock in some attractive coupons and a potential guaranteed income for life. Where did Treasury yields close out the week? So, for those of you who are laddering MYGAs and Treasuries in the base part of your portfolio for a safe, stable, and predictable income stream that hopefully lasts a lifetime, let's kick things off with Treasuries and take a look at Treasury yields from this past Friday across all the maturities that the Treasury issues at auction. This row shows where they closed out the week on August 14th, 2026. And this row here shows the increase or decrease in rates over the past week. And this row here shows the increase or decrease in rates since January 2nd, 2026. Increases in rates are shown in green and decreases in rates are shown in red. As you can see, yields haven't changed all that much this past week. All movements have been mid to lower single-digit basis points only, and the 20-year and the 30-year remained firmly above 5%. The maturities from 2 years to 10 years all kept their four handles, with the 10-year at 4.68%. In the big picture, Treasury yields across all maturities remain at attractive levels compared to the past 20 years, and also above where they were at the beginning of the year. Keep in mind that these Treasury numbers give you a general feeling for where rates currently stand along the maturity spectrum. The yields that you may get when you buy at a specific auction or from a specific broker, or when you sell, will likely differ from what's shown here, depending on when you're transacting. Now, we don't have a crystal ball, and rates could go up or down in the future, but we personally feel that these yields at or near 20-year highs may present a golden moment to build out your Treasury ladder and or lock in a guaranteed lifelong income with annuities, if you're close to or already in retirement. And for those of you who are looking for a truly guaranteed lifelong income stream, like the vast majority of Diamond NestEgg members, super savers, and course folks who've reached out to us personally via email recently, remember that the only way to really do this is via specific types of annuities, such as a fixed indexed annuity or FIA with an income rider, a single premium immediate annuity or SPIA, and or a qualified longevity annuity contract or QLAC. Annuities, like many other fixed income investments, are based on Treasury yields, so their payout ratios are currently at 20-year highs as well. So let's have a quick look at what the rates might look like for 65 and 66-year-old couple in California who invest $100,000 into a FIA with an income rider from an A++ rated insurance company and waited 7 years before they took their first guaranteed annuity paycheck. This couple might earn a lifelong guaranteed income of $12,796 per year from year 8, as long as one of them is alive. And if they waited 10 years before they took their first guaranteed annuity paycheck, they might even have earned a lifelong guaranteed income of $15,200 per year from year 11. And if you're further from retirement, but like the current rates and market levels and want to lock in a future guaranteed lifelong income stream at some point further down the line, the same mechanism from FIAs with an income rider can help you as well. For example, for a $100,000 investment, a slightly younger single male or female of 60 living in Florida who perhaps is willing to take on a bit more risk with an A+ rated insurance company and let his or her money grow for 12 years with roll-ups might start receiving a guaranteed lifelong income of up to $21,012 per year from age 72. Personally, we feel that these are quite attractive guaranteed payouts on a one-off investment of $100,000 and may or may not be easy to replicate if the investors in our example were to wait to lock in their lifelong guaranteed income. Keep in mind that all the annuity rates and numbers mentioned in this video are for illustrative purposes only. Your personal rates and conditions are not locked in until you sign your annuity contract. And as always, email us at jennifer@diamondnestegg.com if you'd like to get connected with a trusted annuity specialist to see what your personal rates and conditions might look like whenever you might be watching this video. There's no one-size-fits-all cookie-cutter solution. Any annuity you buy should be customized specifically for you. And let's move on now to the next part of today's discussion. For those of you who may not necessarily be looking for guaranteed income for life and who don't mind giving up on some liquidity for potentially higher yields than what Treasuries can offer that are still safe. How much more can you earn with multi-year guaranteed annuities, or MYGAs, from top-rated insurance companies? Here are some illustrative sample MYGA rates from an A++ versus an A+ insurance company that we work with. Remember that A++ is the best credit rating that an insurance company can get from AM Best, meaning the MYGAs from the A++ insurance company that we're about to share with you are the lowest risk, making them the most comparable to Treasuries in terms of risk-return profile. An A+ is the second best credit rating that an insurance company can get from AM Best, so still very safe in the overall big picture, generally speaking, but maybe not as safe as Treasuries, especially if you were to go above the protection limits of your state guarantee association. In this top section, we'll go through what the numbers look like for an A++ insurance company, and in this bottom section, we'll go through what the numbers look like for an A+ insurance company. Here you have the investment amount required, and here you have the guaranteed MYGA term from 2-year all the way up to 7-year for the A++ insurance company, and for a 3-year MYGA, 5-year MYGA, and 7-year MYGA for the A+ insurance company. For this A++ insurance company, rates are still in the same range as last week, although with some smaller adjustments of a few basis points around the edges. For a 5-year MYGA, you might be able to get to 5.1% for a $100,000 investment, about 74 basis points more than a 5-year Treasury, which is paying 4.36% at the current time. For a 6-year MYGA for a $100,000 investment, you might be able to get to 5.1% right now as well. And for a 7-year MYGA for a $100,000 investment, you might be able to get to 5.15%, about 64 basis points more than a 7-year Treasury, which is paying 4.51% at the current time. And of course, if you were to invest more than $100,000, those rates would be even higher. For a $1 million investment, you might be able to earn 5.15% on a 5-year or a 6-year MYGA currently, and even 5.2% on a 7-year MYGA. As always, keep in mind that the MYGA rates in this table are illustrative, dependent on a number of factors, and subject to change at any time without prior notice, and that your personal rates and conditions are not fixed before you sign your annuity contract. And if you're willing to cast your net a bit wider for this A-plus insurance carrier here, with $100,000, you may now be able to get to 5.3% with a 3-year MYGA, 5.55% with a 5-year MYGA, and even 5.65% with a 7-year MYGA, a full 114 basis points more than for a 7-year Treasury at 4.51%. Higher risk, higher return, right? But as I always say, everyone's financial journey is different, and an A-plus rated insurance company is still the second best credit rating that an insurance company can get from AM Best, as I mentioned earlier. Always stay under your State Guarantee Association's threshold, and don't forget that MYGAs are generally not liquid and don't pay regular interest. So, if any of these rates are interesting to you, or if you want to see what your MYGA, FIA, or other annuity options might look like whenever you're watching this video, email us at jennifer@diamondnestegg.com so that we can connect you with our trusted annuity specialist who can help you find the best annuity solution that's out there for you. All right, Diamond NestEgg members, super savers, and course fans, I hope you enjoyed today's video and learned something new. And see you again very soon with more brand new wealth building content for your financial journey.